So now we are moving along to the fun bit, and this is the introduction to market analysis. Look, one of the beauties about markets, and one of the things that I certainly enjoy about markets, is that there are no rules in markets. So however you choose to trade is fine. There's lots of different ways to trade and lots of different ways to make money. But having said that, most traders in the market, there's two types of analysis that they use. And one of those is called fundamental analysis, and the other one is called technical analysis. So, look, fundamental analysis, basically, the definition of that is quite simply, it's just using economic and financial and other qualitative and quantitative factors to analyse a market and to give traders trade triggers. Now, markets can be skewed away from fundamentals in the short term, but markets always, in the long term, revert to fundamentals. So, look, fundamentals certainly are very important. You can't really ignore them. Look, just for an extreme example, for example, if the world economy had an economic shock and went into a recession, look, the markets certainly, if they were trading bullish before that economic shock, they certainly would not continue to trade bullish, that they would revert to those fundamentals and they would trade bearish. To give you just another example of how traders may use fundamentals is that before a trading week starts, traders will have a look at the economic calendar. And on an economic calendar, you'll have lots of different economic releases. You may have US inflation, CPI data, which is always important. You may have central bank meetings. And so what traders will do is they'll try to analyse where they think, for example, that CPI data may come in, whether or not they think it comes in hot, or they analyse it and they think it may come in weaker. Certainly then they will target the markets that weaker or stronger number will create the volatility. So for example, normally with CPI numbers, we normally see the bond market and bond yields react. And whether those bond yields go higher or lower, then that will also then impact on currency trading and if you're looking at US CPI numbers, obviously whether or not the US dollar trades stronger or weaker. So yes, look, traders look at all the economic data releases, especially the important ones. Use CPI for this example, but obviously GDP data, obviously employment data is very important. And yes, certainly when central banks meet and make decisions on interest rates, these sort of economic events, risk events, certainly move markets, and analysing those markets before they happen give traders an edge to react when that economic data actually comes out. So, besides obviously fundamental analysis, just using economic skills to analyse markets, the other big way that a lot of traders they use is called technical analysis, and just generally technical analysis is almost the complete opposite to fundamental analysis, where the technical analyst believes that all the fundamentals is already baked into the price. So a pure technical trader does not care about fundamentals at all, and so basically he's more concerned with price movement and also historic price movement and how that will predict future prices, which then he can trade on. Technical analysts also use a lot of technical indicators and chart patterns to help them make those decisions. Now, technical analysis and technical trading certainly now has grown in importance in the markets, where we are seeing up to 70% of global volume, and that's across all asset markets, traded in a technical manner. And generally now it is more algorithm, quantitative driven, and that is generally done by the big banks, also hedge funds, money managers that manage most of the big funds, the billions of dollars globally. So yes, technical analysis now is something that a lot of the market certainly uses, watches, and very important. Now look, regardless of whether or not you use technical analysis or fundamental analysis, it's just about doing the work. There's obviously, with technical analysis, There's so many different types of technical analysis that you can study, and if you want to master some of that technical skills, it literally can take you years to master, to get on top of, before you're able to use it confidently and use those technical skills, obviously, on a consistent, profitably basis. But just to summarise, again, going back to the original point, there are no rules in markets how you choose to trade. And you could actually also trade a combination of both hybrid of fundamental and technical analysis, so that you can start off with fundamental analysis and make sure the trade makes sense, and then look at the technicals, and if they back up the fundamentals, obviously that's going to give you a lot more confidence in what you're doing and potentially way more profitable trades. But at the end of the day, most traders will pick an analysis that they enjoy and something that obviously they understand, obviously something that they're good at. And so that's always up to the individual. It's going to be up to you exactly how you want to trade. And again, I can't emphasize enough, there are no rules. So whether or not you're happy to be a fundamental analysis or you want to trade technically, it's okay. It's just about doing the work, and certainly if you do the work, you will get positive outcomes.